this morning we'll be looking at property, plant, and equipment. We'll just wait one more minute for the rest of the class to join. Okay. Okay, guys, I'm starting now, so hopefully you guys can hear me. Maybe you can just confirm. I was just waiting for the rest of the class to join, and I am sharing my slides. So we'll put a notice up today on the scope, but it's going to be everything you've done up until the assessment date. So it shouldn't include PPE Part 3 on revaluations because you wouldn't have done all the tutorials. Okay, but just have a look at your announcements at the end of today. Okay. Can you guys all see the slides? Okay, let's start. So previously we looked at PPE Part 1, where we recapped some of the material you studied last year. And then last week we did impairments, where we did impairments and change in estimates. So change in estimates was new for you guys, but impairments you did see in second year. So this week we're going to be looking at the revaluation model. So let's just have a look at an overview of Unit 2 to recap. So we looked at the objective of IAS 16, and we looked at the scope in previous weeks. We also looked at the definitions and the recognition criteria. We looked at how to measure PPE initially. Remember, we had to decide what costs to include, like delivery costs, are they included, installation costs, training costs. We also looked at different elements of cost, and we looked at measurement after recognition. This is subsequent measurement, things like depreciation and impairments. And there were two models that we saw. So we've looked at the cost model. Today, we'll be looking at the revaluation model in more detail. We looked at depreciation and subsequent expenditure. And then we also looked at derecognition, what to do when an asset is disposed of. And we looked at some presentation and disclosure. We'll be looking at presentation and disclosure again today when we look at the revaluation model. So what is our learning objective today in Part 3? We are going to apply the revaluation model when we measure an item of property, plant, and equipment. Previously, we were using the cost model, but Now we are going to look at the revaluation model. Okay. Someone is saying they can't see the slides. Maybe you guys can just confirm that you can actually see it. Can you guys hear me and see the slides? Okay. The slides are visible and you should be able to see me. Okay. So what is out of scope for this section? So if you're looking at your Gripping GARP textbook, there are a number of sections that are out of scope. So section 3.9.2, which deals with proportionate restatement method. This is the gross replacement value. And section 3.10, which deals with the revaluation model and impairments together. Okay. So we will look at the revaluation model separately and impairments separately. We do not look at those two together. That is out of scope for purposes of this module. Then we have deferred tax consequences. This is also out of scope and disclosure, accounting policies and estimates. Statement of changes in equity disclosure for this topic is out of scope and further encourage disclosure. So all of these things out of scope, if you continue with financial accounting, you may see these in other modules and in other qualifications, but for purposes of this module, they are out of scope. Okay, so here's just a little cartoon. It says, Tom, you're an asset to the company. It's just that you're depreciating. Okay, so maybe when you did conceptual framework, you had to decide if an employee is an asset. Here, the guy is saying you're depreciating, meaning you're getting old. Okay, it's just some humor. Let's move on to the recognition and initial measurement under the revaluation model. So the recognition and initial measurement principles that we learned for the cost model, these are the same and are going to apply when using the revaluation model. So when we look at subsequent measure of PPE, there are two measurement models for PPE, the cost model and the revaluation model. So we have looked at the cost model in prior weeks, and this week we are looking at the revaluation model. So after recognition, a company needs to choose one of two models. So under the cost model, the item of property, plant, and equipment is going to be carried at cost, less accumulated depreciation and impairment losses. Whereas under the revaluation model, which is what we're learning today, the item of property, plant, and equipment will be carried under fair value of the asset, less subsequent accumulated depreciation and impairment losses. You can choose either model here, but the model must be applied to the entire class of assets. So a company will have different classes of assets. For example, vehicles are a different class of assets to equipment and machinery. So for each class, you will need to decide which model to apply. And then, so you can't have some vehicles measured under the cost model and some vehicles measured under the revaluation model. The whole class of the item of PPE must be measured using the same model. Okay, so you could have land measured using the revaluation model, and then vehicles measured using the cost model. That is fine, but it must be applied to the entire class of assets. And remember, one class will be vehicles, another class will be machinery. Okay. So what is fair value? When we say that we need to measure the asset at fair value, what does it mean? So this is the price that would be received to sell an asset in an orderly transaction between market participants at the measurement date. So the fair value of PPE is going to be determined by an appraiser. And this is going to be determined regularly, and it will depend on movements in fair value, how often it is going to be appraised. When we appraise maybe a item of like a building or a piece of land, the entire class should be revalued. So we're not just going to revalue one building or one land. The entire class that is measured using the revaluation model needs to be revalued. So carrying amount is going to be revalued to fair value under the revaluation model. So with the assets carrying amount is going to be determined, and this is going to be compared to the fair value and an adjustment done. So this may mean that the carrying amount increases or decreases depending where the fair value is in relation to the carrying amount. So just remember that the carrying amount, this is going to be determined by taking the cost minus the accumulated depreciation and impairments. So how often are we going to perform the revaluation? So revaluations, they do not need to be performed every year, but they must be done regularly or periodically, and the entire class should be revalued. So what are we going to do under the revaluation model? So under the revaluation model, we said that the fair value of the item of property, plant, and equipment is the market value, and this is going to be determined by an appraiser. This is going to be determined regularly, depending on how often the fair value is expected to change. Okay, so if the fair value is expected to change often, then we will have to perform or get an appraisal regularly. So the entire class should be revalued, and every time an asset is revalued, the fair value of the asset is going to be compared to the carrying amount, and any increases to the carrying amount up to fair value, this will be taken to an account called the revaluation surplus account. For any increase in the revaluation, we are going to credit revaluation surplus, and we're going to debit the cost of the PPE item. So when we have an increase and the carrying amount is increasing to fair value, the journal is going to be credit revaluation surplus and debit cost of PPE. If we have the opposite, if we have a decrease in revaluation and the carrying amount is decreasing to the fair value, we're going to do the opposite. We're going to debit revaluation surplus, and we're going to credit property, plant, and equipment. So the revaluation surplus, it must have a credit balance. So if the balance goes to a debit, we're going to leave it at zero and expense the rest. So this means that you can only have a decrease in the revaluation surplus accounts to the rand value of what the previous revaluation surpluses were. Okay, we'll see this in an example just now, but the revaluation surplus must have a credit balance. If the balance goes to a debit, we're going to stop and leave it at zero, and we're going to expense the rest. So let's have a look at an example here. So we have land with a carrying amount of 100,000, and this is revalued to a fair value of 120,000. The asset had not previously been revalued. So you know that land is not depreciated, and they told us here that the land carrying amount is 100,000, and it is revalued to a fair value of 120,000. So here we are going to compare the carrying amount of the land, which is 100,000, and we're going to compare it to the fair value. And we'll see that the carrying amount is lower than the fair value. So here we are going to increase the carrying amount to the fair value of 120,000. So under the revaluation model, we can increase the value of the item of PPE because often these fair values will be higher or greater than the carrying amount. So the journal to record the 20,000 revaluation is debit land cost with 20,000 and credit revaluation surplus. So the revaluation surplus, this is going to be recorded in other comprehensive income. So you can see we are increasing the value of the land. We are saying debit land with 20,000 and we are crediting revaluation surplus. This is equity with 20,000. So here the carrying amount increased to the fair value. Let's have a look at example 2. So under example 2, we have another scenario. We have land with a carrying amount of 100,000, and this is going to be revalued to a fair value of 80,000. So here you can see that the fair value is lower than the carrying amount. And they tell us the asset had not previously been revalued. So if this asset had not previously been revalued, it means there's nothing sitting in the revaluation surplus account. So because there's nothing in the revaluation surplus account, we cannot debit the revaluation surplus account in this scenario. So because there's no revaluation surplus from a previous revaluation relating to this item of PPE, here we are going to reduce the carrying amount from 100,000 to the fair value of 80,000, but we are going to debit it to revaluation expense. So our journal is going to be debit revaluation expense, which is an expense in the statement of profit and loss, and we are going to credit land cost. So we are reducing the value of the land from the carrying amount of 100,000 to the fair value of 80,000. So we're debiting revaluation expense, which is an expense in the statement of profit and loss with 20,000, and we're crediting land with 20,000. So in this scenario, the revaluation results in a decrease to the carrying amount of land to the fair value. But because there was no amount in the revaluation surplus account, we are debiting revaluation expense. Now we have another example, example 3. Here we have land with a carrying amount or fair value of 120,000. Land is revalued to fair value of 70,000 on 1 Jan 20x2. So the land originally cost 100,000 and had been revalued on 1 Jan 20x1 to 120,000. Since land is not depreciable, the balance on the revaluation surplus from the previous revaluation was still 20,000 Rand on 1 Jan 20x2. So we need to now record this journal. So previously on 1 Jan 20x1, the land originally cost 100,000 and it was revalued to 1 Jan to 120,000. So we would have created a revaluation surplus on that date. We would have credited the revaluation surplus. Now we are sitting on 1 Jan 20x2 and the land has a fair value of 70,000 and we are comparing the carrying amount of 120,000 to the fair value on 1 Jan 20x2 of 70,000. So you can see that the carrying amount is 50,000 greater than the fair value. So we know that there's going to be a decrease in land of 50,000, okay? So we can start by saying credit land cost with the difference between the carrying amount on 1 Jan 20x2 of 120,000 and the fair value on that date of 70,000. So we know that land is going to decrease by 50,000, credit land cost. But now we need to know what accounts are we going to debit. So the revaluation surplus account has a balance of 20,000, a credit balance. So we can debit revaluation surplus with 20,000. And remember, this is in other comprehensive income. So we are essentially reducing the revaluation surplus account to 0. But then we still have 30,000 left. So that the 20,000 decrease in revaluation surplus leaves 30,000 still that we need to put somewhere. So because we have reduced the revaluation surplus account to 0 by debiting the revaluation surplus account with 20,000, now we are going to debit revaluation expense with the remainder, which is 30,000 Rand. And remember, the revaluation expense, this is an expense account, and it is in the statement of profit or loss. So this is a good example where we have a credit on our revaluation surplus account from a previous revaluation, but not all of it is going to be able to go and be debited against the revaluation surplus account. Okay, so someone has asked me to explain again. So here, if we read, the land carrying amount has a fair value of 120,000. Land is revalued to fair value of 70,000 on 1 Jan 20x2. The land originally cost 100,000 and it had been revalued on 1 Jan 20x1 to 120,000. So do you agree that when this was previously revalued to fair value, it would have resulted in a credit to revaluation surplus of 20,000 Rand? So now when we come to 1 Jan 20x2, the land needs to be revalued again. The carrying amount is 120,000 and the land is revalued to fair value of 70,000. So this results in a 50,000 decrease in the value of land. So we are going to credit land cost with 50,000. We are going from the carrying amount of 120,000 to the fair value of 70,000. So this is a 50,000 decrease in the cost of land. So we currently, from the first revaluation on 1 Jan 20x1, we had a revaluation surplus of 20,000. We can now debit our revaluation surplus account with 20,000. We are reducing the revaluation surplus credit to 0 by debiting revaluation surplus. Then the remainder of the decrease, which is 30,000, this is going to be debited to revaluation expense. So we're going to debit revaluation expense, which is an expense in the statement of profit and loss, with 30,000. So this shows that our carrying amount is decreasing to our fair value, but we can only reduce and debit the revaluation surplus accounts as much as there was a credit balance. So because the credit balance was 20,000, we can only debit this revaluation surplus account with 20,000. So the remainder will be debited to the revaluation expense account. Okay. So when the asset's carrying amount is increased above its historical carrying amount, this is going to result in a credit to revaluation surplus. So it doesn't make sense for this revaluation surplus to remain in the accounting records indefinitely. So the revaluation surplus must be removed from the accounting records by the time the revalued asset no longer exists. So the revaluation surplus is going to be removed by transferring it to retained earnings. So when should this transfer take place? So you'll see that there's different methods to transfer the amount in the revaluation surplus account to the retained earnings account. So there are 3 different methods in which the revaluation surplus can be transferred to retained earnings. The first one is to transfer it annually to retained earnings. or we can transfer it when the asset is fully depreciated or retired, or we can transfer it when the asset is disposed. So for purposes of this chapter, the revaluation surplus is going to be transferred to retained earnings over the life of the underlying assets, unless otherwise stated. So this means as we depreciate the asset, we are going to also transfer an amount from the revaluation surplus account to the retained earnings account. So what is the journal entry when we transfer an amount from the revaluation surplus account to the retained earnings account? This is going to be the journal entry. So remember, when we created the revaluation surplus account, we credited the revaluation surplus. Now, because we are transferring and reducing the revaluation surplus, we are going to debit this account. So we're going to say debit revaluation surplus, which is another comprehensive income. We are reducing the revaluation surplus account, and we are transferring it and increasing the retained earnings account. So the retained earnings account is equity. So you can see that we are transferring from one equity account to another. We are reducing the revaluation surplus account, and we are releasing it to retained earnings. And remember, we said for purposes of this module, this will be done over the useful life of the asset. So that is the journal we are going to do. So when we look at the revaluation model, we also need to be aware that there are two types of revaluation methods: the elimination method and the proportionate method. So we are only going to focus on the elimination method, which is the net replacement value method. So the other method, the proportionate method, that is scoped out of this module. So when you see all of our tutorial and practical examples, all of them will use the elimination method. So here we have an example from the textbook. So this is example 8. So the revaluation model using the net replacement value method. So we have the plant, and that was bought on 1 Jan 20x1 for 100,000 cash. We are told that the depreciation is straight line over 5 years to a nil residual value. The fair value at 1 Jan 20x3, which is 2 years after purchase date, is 90,000. And the required says calculate the net replacement value. So that is part A. Part B says provide the journals for the years ended 31 December 20x1 to 20x3. So the question says ignore tax and the transfer from the revaluation surplus. So for A, it says calculate the net replacement value. So the net replacement value on 1 Jan 20x3, that was given, that is the fair value of 90,000. Okay, this is the net replacement value. So part B says provide the journals for the years ended 31 December 20x1 to 20x3. So on the date of the fair value that is given, we need to calculate the carrying amount. So there are various steps that we are going to perform when we have a revaluation. So step 1, we are going to calculate the carrying amount on the same date that the fair value is given. So for this example, the fair value was given on 1 Jan 20x3. So we are going to calculate the carrying amount on 1 Jan 20x3. We are then going to compare the carrying amount to the fair value, and we are going to see if there was a revaluation. Then step 4, we are then going to calculate depreciation. And we do that by taking the new fair value, that becomes our new cost or carrying amount, and we are going to divide by the remaining useful life. Similar to how we calculated the remaining useful life when we had an impairment or a change in estimate, we are going to do the same here. but we're going to take the fair value if we are using the revaluation model, and we're going to divide by the remaining useful life. So these are the steps we are going to follow. Let's now apply them to the example. So in the example, it said that the cost of the asset on 1 Jan 20x1 was 100,000. And we need to calculate the carrying amount 2 years later on 1 Jan 20x3. So we need to provide for depreciation for 20x1 and 20x2. So remember, the cost of the asset was given at 100,000 and the useful life is 5 years. So we're going to take 100,000 divided by 5 years, and that is going to give us depreciation of 20,000 for 20x1 and depreciation for 20x2 of 20,000. So remember, the depreciation is straight line, there is no residual value, and the useful life is 5 years. So we left with depreciation for 20x1 of 20,000 and depreciation for 20x2 of 20,000. So now we can determine the carrying amount on 1 Jan 20x3 by taking the cost of 100,000 minus the depreciation of 20,000 minus the depreciation for 20x1 and the depreciation of 20,000 for 20x2. That leaves us with a carrying amount of 60,000 on 1 Jan 20x3. Now we are going to compare the carrying amounts calculated in step 1 to the fair value. So the carrying amount on 1 Jan 20x3 is 60,000, and we are going to compare that to the fair value on 1 Jan 20x3 of 90,000. So we are in step 2, we have calculated the carrying amounts, and now we are comparing it to the fair value. Now we need to see if there is a revaluation. So when we compare the fair value to the carrying amount, that leaves us with a 30,000 revaluation. So we are going to increase the carrying amount from 60,000 to the fair value of 90,000. So we have a revaluation surplus. Okay, the fair value was given to us in the question. This is not something you will determine. This will always be given, okay? It is determined by an appraiser who is an expert in fair values. You are not an expert in fair values, so we will always give you the fair value. So when we compare the fair value and the carrying amount, we can see the carrying amount, there's a difference of 30,000 between the fair value and the carrying amount. So that 30,000 now is going to be our revaluation surplus, and that is going to go to other comprehensive income. So the revaluation surplus account will be credited with 30,000. So we will debit PPE plant 30,000 and credit revaluation surplus 30,000. Step 4 said calculate depreciation. So now we are going to take the new fair value, which was given to us in the scenario of 90,000, and we're going to divide by the remaining useful life. So remember, the total useful life given at the date of purchase was 5 years. We've already depreciated for the 2021 year and the 2022 year. So we've already depreciated for 2 years. So if we take the total useful life of 5 years minus the years we have already depreciated, we are left with a remaining useful life of 3 years. So now we can take the remaining useful life and we will take the fair value of 90,000 divided by the remaining useful life of 3 years, and that will give us 30,000. Okay. So remember the 5 years, that is the total useful life that was given in the scenario. That is straight line depreciation. Okay. But here, once the revaluation is done, you need to take the fair value in step 4 minus the remaining useful life. So you cannot use 5 years. So you're going to see how many years have you already depreciated. And in this question, we depreciated 2 years for 2021 and 2022. So that leaves us with a remaining useful life of 3 years. Okay. Now let's have a look at the journals. So we have journals here using the net replacement value method. So on the one, okay, so we're doing the journals right from the beginning. So on the date of purchase, we had plant cost at 1 Jan 20x1. The plant was purchased for 100,000 Rand, and the journal process was debit plant cost 100,000, credit bank 100,000. This is the purchase of the asset, okay? This amount was given in the scenario. Then we had depreciation for 20x1. So remember, we calculated the depreciation by taking the 100,000 cost minus the residual value of 0 divided by 5 years useful life. So all of these numbers were given in the question: the cost, the residual value, and the useful life. And this resulted in depreciation of 20,000 Rand for the 20x1 year. And the journal for that is to debit depreciation plant expense and credit plant accumulated depreciation. So that is depreciation for 20x1. Then we have depreciation for 20x2, and it's the same. We're going to take the cost of 100,000 minus the residual value of 0 divided by the remaining useful life of 5 years. And that is going to give us 20,000 depreciation. So we're going to, again, debit depreciation plant, credit plant accumulated depreciation. So this is depreciation for 20x2. You'll see it's the same as 20x1. Now, just before the revaluation is done, remember we are using the net replacement value method. And this is it's the elimination value method. So just before the revaluation is done, we need to set off the accumulated depreciation against the plant cost. So we're essentially working out the carrying amount of the item of PPE. So we're going to do our net off. So we're going to set off our accumulated depreciation against the plant cost. And we do this because the question told us we're using the net replacement value method. So we're going to say debit plant accumulated depreciation, and we're going to take the depreciation of 20,000 from 20x1 and 20,000 from 20x2. And then we're going to credit plant cost with 40,000. So here we are simply doing a set off. We are setting off the accumulated depreciation against the plant cost, and we do it just before the revaluation. So you'll see the fair value is given on 1 Jan 20x3. We are doing the set off on 1 Jan 20x3. Then once we've done the set off, we can calculate our revaluation surplus. And remember, when we did the steps, we compared the fair value given of 90,000 to the carrying amount we determined of 60,000. And we saw that we needed to increase our carrying amount from 60,000 to our fair value of 90,000. And this resulted in a revaluation of 30,000. So we're going to debit plant cost with 30,000, and we're going to credit revaluation surplus with 30,000. So here we are revaluing our assets. We are creating a revaluation surplus account with 30,000. So we're debiting plant cost. We are increasing the value of our plant from the carrying amount of 60,000 to our fair value of 90,000. And we are crediting and creating the revaluation surplus account. And remember, I said this is equity, and it is shown in other comprehensive income. So now we have revalued the asset. Now the value of the plant will show 90,000 Rand. Now we have revalued our assets. Now remember, step 4 was to calculate depreciation based on the new fair value. So we're going to take the fair value of 90,000 and we're going to divide it by the remaining useful life. So our fair value was 90,000. Our residual value is still 0. And remember, we calculated the remaining useful life as 3 years. The question told us on 1 Jan 20X1, we had a total useful life of 5 years. Then we depreciated the asset for 20X1 and 20X2, and that left a 3-year remaining useful life. And it is that 3 years that we use for depreciation. So we're going to say fair value 90,000 minus the residual value of 0 divided by 3-year remaining useful life, and that leaves us with depreciation for 20X3 of 30,000. So we're going to debit depreciation plant, and we're going to credit plant accumulated depreciation. So that is the journal entries relating to the revaluation. So now we have another example here. We have a revaluation model which shows an increase in value creating a revaluation surplus. So here we have a similar scenario. We have plant purchase on 1 Jan 20X1 at 100,000 and the depreciation is straight line over 5 years to a nil residual value. The fair value is given to us on 1 Jan 20X2. So that is 1 year after purchase of 90,000. And they tell us the revaluation surplus is transferred to retained earnings over the life of the assets. So here we are going to transfer, once we create our revaluation surplus account, we then need to transfer a portion to retained earnings as we depreciate the asset. The required says show the journals for the years ended 31 December 20X1 and 20X2 using the net replacement value method. So they're telling us to use the net replacement value method. So you know there's going to be a set-off of accumulated depreciation against the cost of the plant just before the revaluation. So let's have a look at our steps. Remember, the first step was to calculate the carrying amount on the same date as the fair value. So we are going to calculate the carrying amount on the same date that the fair value is given. So we need to depreciate the asset for 1 year for 20X1, and the fair value was given on 1 Jan 20X2. So once we have calculated the depreciation for 20X1, then we are going to determine the carrying amount on 1 Jan 20X2. So the depreciation for 20X1, we are going to take the cost of 100,000 divided by 5 years, and that will give us an amount of 20,000 Rand. So this is the depreciation for 20X1. Then we have the carrying amount on 1 Jan 20X2. So we are going to now take the cost of the asset, which was 100,000, minus the 20,000 depreciation for 20X1, and that will leave us with a carrying amount of 80,000 on 1 Jan 20X2. So now we have the carrying amount of 80,000. This is now on the same date that the fair value is given. So the fair value is given as 90,000. So we have the carrying amount on 1 Jan 20X2 of 80,000, which we have calculated. Now we are comparing that to the fair value on 1 Jan 20X2 of 90,000. So we are comparing these two, comparing the carrying amount to the fair value. And then in step 3, now we have a revaluation. So we have, we are comparing the fair value of 90,000 to the carrying amount of 80,000. And when we compare the two, we'll see the carrying amount is lower than the fair value. So we are going to increase the carrying amount to the fair value of 10,000 Rand. So we have a revaluation surplus of 10,000 Rand. So remember, we are going to debit plant cost and we're going to credit revaluation surplus. And the revaluation surplus is equity shown in other comprehensive income. Now we have determined what the revaluation is. Now step 4 is to calculate the depreciation. So remember, under step 4, we are going to take the fair value. We revalued the carrying amount up to the fair value. So the value of the asset now is 90,000. So this is the amount we are going to depreciate. We are going to divide it by the remaining useful life. So the remaining useful life can be determined by taking the total useful life of 5 years minus the year we have already depreciated for, which was for 20x1. So the remaining useful life is 5 years, which is the total useful life, minus the 1 year for 2021, which was depreciated, and that will leave us with a remaining useful life of 4 years. So now we can determine the depreciation for 20x2. So we're going to take the 90,000, which is the fair value, divided by the remaining useful life, which is 4 years. So that is the depreciation for 20x2, and we determined it by taking the fair value of 90,000 divided by the remaining useful life of 4 years. Now let's have a look at our journals. So on 1 Jan 20x1, when the asset was purchased, we can record the plant cost. So on 1 Jan 20x1, the asset was purchased. We are going to debit plant cost with 100,000 and credit bank with 100,000. So this is the purchase of the assets. Then at the end of 20x1, we are depreciating the assets. So we are taking the cost of 100,000 minus the residual value of 0 and dividing it by the total useful life given of 5 years. So we are working out the depreciation and we get 20,000. And our journal for the depreciation is to debit depreciation plant, credit plant accumulated depreciation. Then just before, remember the revaluation happens on 1 Jan 20x2. On the same date that the revaluation happens, just before the revaluation, because we are using the net replacement value method, we need to set off the accumulated depreciation against the cost of the plant before revaluing the assets. So we are going to debit plant accumulated depreciation. We are setting off the accumulated depreciation against the plant cost. And we are crediting plant cost. Here we are setting off the accumulated depreciation against the plant cost, and we are doing this because we're about to revalue the asset. Then we have the revaluation. So here, remember we compared the fair value given of 90,000 to the carrying amount we determined, which was 80,000. So when we compared the fair value to the carrying amount, we saw that we had a revaluation of 10,000 Rand. So here we are going to credit the revaluation surplus account. So we are debiting plant cost with 10,000 Rand, and we are crediting revaluation surplus account with 10,000 Rand. So we are processing our revaluation journal. So now we once we process this journal, the cost of the plant is now going to reflect the fair value. Then once we have processed the revaluation, now we need to provide for depreciation for 20x2. So remember step 4, we took the fair value of 90,000 minus the residual value of 0 divided by the remaining useful life of 4 years. So we are going to debit depreciation plant with 22,500 and we are crediting plant accumulated depreciation with 22,500. So this is the depreciation. We are taking the new carrying amount, which is our fair value of 90,000, and we are dividing it over the remaining useful life of 4 years. Then remember I said we need to transfer a portion from our revaluation surplus account to retained earnings. And we are going to do this over the life of the asset. So remember, due to the revaluation, we created or credited the revaluation surplus account with 10,000 Rand. So that 10,000 Rand is now going to be transferred to retained earnings over the remaining life of the asset. So just like we worked out the depreciation and we divided by 4 years remaining useful life, here we are dividing by 4 years remaining useful life. So we're taking the 10,000 divided by the 4 years, and that will leave us with 2,500 Rand. This is the transfer from revaluation surplus to retained earnings. So here we're going to debit revaluation surplus. We are reducing the revaluation surplus accounts and we are crediting retained earnings. So our revaluation surplus account is getting smaller, but our retained earnings account is getting bigger. And the amount is 2,500 Rand. So we're transferring the revaluation surplus to retained earnings. Okay. So this example is a good one because it shows the whole process. Okay. Let's move on though to some disclosure under the revaluation model. So when we have disclosure, so the disclosure of property, plants, and equipment under the revaluation model, this will involve disclosing things like accounting policies to be included in the notes to the financial statements. We will also need to disclose in the statement of profit or loss and other comprehensive income all the items relating to that asset. So these would be like whether there's a revaluation expense, it would be depreciation relating to the asset as well. The statement of financial position, this will show the line item of the property, plant, and equipment. So remember, this line item will come from that property, plant, and equipment note. And then we'll have the statement of changes in equity. This will be covered in semester 2. So we're not going to look at that right now. So the following needs to be disclosed if the revaluation model has been selected. So we'll need to disclose the effective date of the revaluation, what date was the appraisal done, and whether the appraiser was an independent valuer or not. We'll have to also, so even though we are using the revaluation model, we will have to disclose the carrying amount as if the cost model had been used as well. So we'll have the carrying amount under the revaluation model, and then as a comparison, we'll have carrying amount according to the cost model. And the reason for this is that we want the financial statements to be comparable to other companies. So if our company uses the revaluation model for buildings, we'll want to be able to compare it to companies that use the cost model for buildings because it affects the value of our assets. So even if the revaluation model is used by a company, they'll need to disclose the carrying amount according to the cost model. Then we'll need to disclose the methods and assumptions applied for estimating fair value. And then we'll need to disclose the extent to which the fair value was determined directly by reference to price or using valuation techniques. Okay, so that is what needs to be disclosed. Here we have a disclosure example on slide 31. So company C acquires a machine on 1 Jan 2010 for 800,000. Management estimates the useful life of the machine to be 8 years. It is the company's policy to revalue the machine every 3 years. On 1 Jan 2013, the fair value was determined at 1,020,000. So for purposes of this example, we're going to ignore the transfer from the revaluation surplus account to retained earnings. And the required says prepare the journal entries for the reporting period ended 31 December 2013. Prepare the notes to the financial statements as at 31 December 2013. Okay, so we'll start with the journals. Obviously, we need to go through all of the steps. So remember that the machine was acquired on 1 Jan 20X1 and the useful life was determined to be 8 years on that date. So in 3 years' time, which is 1 Jan 2013, the fair value was determined at 1,020,000. So we are now going to follow our steps to revalue this asset. So we are going to calculate the carrying amount on the same date that the fair value is given. So the depreciation for 2010, so we need to depreciate for 3 years. So the asset was purchased on 1 Jan 2010 and the revaluation was done on 1 Jan 2013. So we are going to depreciate the asset for 2010, 2011 and 2012. So we're going to take 800,000, which is the cost of the machine, and we're going to divide by the useful life of 8 years. So we're going to take 800,000 divided by 8 years, and this will give us depreciation for 2010 of 100,000. Then we're going to do the same for 2011. We're going to take the cost of the machine of 800,000 divided by the useful life of 8 years, and this will give us 100,000. And depreciation for 2012, which is the last year before the revaluation, we're going to take the cost of 800,000 divided by the useful life of 8 years, and this will give us depreciation of 100,000. So the carrying amount on 1 Jan 20X3, so we're going to take the cost of 800,000 minus the depreciation for 2010, minus the depreciation for 2011, minus the depreciation for 2012, and that will give us 500,000 carrying amount on 1 Jan 2013, which is the date of the fair value. So now we're going to compare the carrying amount to the fair value. We have calculated the carrying amount in step 1. The carrying amount was 500,000 and the fair value was given to us as 1,020,000. So here we have a fair value that is higher than the carrying amount. So now we need to determine, do we have a revaluation? Yes, we do. The fair value is higher than the carrying amount, so we are going to increase the carrying amount to the fair value. So we are going to increase the fair value to the carrying amount, and we are going to do that by processing a journal to revaluation surplus. So we're going to say fair value of 1,020,000 minus the carrying amount of 500,000, and this is going to give us a revaluation surplus of 520,000. So by processing this journal, the value of the plant is now going to be recorded at fair value of 1,020,000. So in step 4, here we have, we need to calculate the depreciation, and we do that by taking the fair value of 1,020,000 divided by the remaining useful life. So remember, we are going to calculate the remaining useful life. We are going to take the total useful life, which was given in the scenario of 8 years. And remember, we depreciated for 2010, 2011, and 2012. So if we add up how many years did we depreciate for, it's for 1, 2, 3 years. So we have depreciated the asset for 3 years. So when we determine our remaining useful life, we are going to take the total useful life of 8 years minus the remaining useful life, and this will leave us with 5 years remaining useful life. So when we depreciate the asset, we are going to take the fair value of 1,020,000 divided by the remaining useful life of 5 years, and that will give us depreciation for 20x3 of 204,000 Rand. So that is the depreciation after the revaluation. So those are the steps. Now we can process the journal entries. The required said prepare the journal entries for the period ended 31 December 2013. So we're not doing from the date of purchase, which was 2010. So we're going to debit accumulated depreciation. Remember, we're doing our set off just before the revaluation. Because we're using the net replacement value method, we are going to set off all of the accumulated depreciation against the cost of the asset. And we do that by debiting accumulated depreciation. And the amount, remember we determined the depreciation earlier. We depreciated for 2010, 2011, and 2012. When we add all of these together, we get 300,000. So we're going to debit accumulated depreciation with 300,000, and we're going to credit machine with 300,000. So we are setting off our accumulated depreciation against our machine cost. So debit accumulated depreciation, 300,000, credit machine with 300,000. So now that we have done our set off of accumulated depreciation against the cost of the machine, now we can perform our revaluation journal. So here we are debiting machine with 520,000. Remember, this is the amount, this was the difference between the fair value and the carrying amount. So we are debiting machine with 520,000, and we are crediting revaluation surplus with 520,000. So this is our revaluation journal. We are crediting or creating revaluation surplus. And the value of the machinery is now going to be shown at the fair value of 1,020,000 Rand. Now that we have processed the revaluation journal, remember step 4 was to determine the depreciation after the revaluation. So here we are debiting depreciation expense with 204,000, and we are crediting accumulated depreciation machine with 204,000. So this is the depreciation processed after the revaluation. So that is the journals for the revaluation for this question. This is the disclosure in the statement of financial position at 31 December 2013. So here we have non-current assets. Remember, property, plant, and equipment is going to be disclosed as a line item under non-current assets. And this line item is going to be the carrying amount from the property, plant, and equipment note. So note 2, property, plant, and equipment under non-current assets. So now let's have a look at the other disclosure. So we need to have our accounting policy note. So often this information comes from the question. So we know from the question that the machinery is measured under the revaluation model and is revalued every 3 years. So it is carried at fair value less accumulated depreciation and impairment losses. Depreciation is provided on all property, plant, and equipment over the expected economic useful life to expected residual values using the following rates and methods. So machinery at an expected useful life of 8 years. So here we are just repeating information that is given to us in the question. We are saying what the accounting policy is, how we do under the revaluation model for this company. They told us in the scenario that the revaluation model is used and the machinery is revalued every 3 years. So we know that it is going to be carried at fair value, less accumulated depreciation and impairment losses. And they told us that the machine has a useful life of 8 years in the scenario. Then we have our PPE note. So this is going to show us the value of PPE. So that line item in the statement of financial position, that comes from the closing carrying amount at the end of the year. So we have the cost price, which was given to us as 800,000, minus the accumulated depreciation for 2010 and 2011. And that gave us an opening carrying amount of 600,000. Then we had depreciation for 2012 in the current year. So the closing balance at the end of 2012 is the cost price of 800,000 minus the accumulated depreciation, which is made up of the opening balance of 200,000 plus the current year movement of 100,000. So that gives us accumulated depreciation of 300,000. So we take the cost price of 800,000 minus the accumulated depreciation of 300,000, and that gives us the carrying amount of 500,000. Then this becomes the closing balances for 2012 now become the opening balances for 2013. So the cost price is 800,000. And that is taken from the closing balance from 2012. So it becomes the opening balance at the beginning of 2013. And then we have the accumulated depreciation. So the closing balance was 300,000. This now becomes the opening balance. So cost of 800,000 minus the accumulated depreciation of 300,000. So that will give us a carrying amount at the beginning of the year of 500,000. Then we had the revaluation in 2013. So we had the revaluation surplus of 520,000. Remember, when we compared the fair value to the carrying amount, this resulted in a credit to the revaluation surplus account of 520,000. Then step 4 in our 4-step process was to calculate the depreciation after the revaluation, and we calculated the depreciation as 204,000 Rand. So that is the depreciation for the 2013 year after the revaluation. Then we needed to calculate our closing balances. So remember, when we processed the revaluation, we debited plant cost and we credited the revaluation surplus. So under the revaluation model, the cost price of the plant is going to be the fair value, okay? So this is different to the cost model, and we're using the revaluation model. So we can increase above the historical cost. So So this cost price here of 1,020,000, this is going to be based on the fair value, which was given in the scenario of 1,020,000. And the closing accumulated depreciation, that is going to be the current year depreciation. Remember, just before the revaluation, we set off the accumulated depreciation here. So we set off the 300,000 Rand. Remember, we said debit accumulated depreciation, and we credited the plant cost. So we set off this 300,000. So we cannot include it in the closing balance. This closing balance will only be made up of the current year movement on the depreciation of 204,000. So then we have our cost price at the end of the year minus the accumulated depreciation, and that will give us a closing carrying amount of 816,000 at the end of 2013. So this is the carrying amount at the end of the year. So these now become the line items in the property, plant, and equipment. Okay. So just check these line items. This is going to be taken to your statement of financial position at 31 December 2013. You're going to show property, plant, and equipment under non-current assets, and you're going to reference to the PPE note, and you're going to show the closing balance is 816,000 and the comparative year is 500,000. So that agrees to your PPE note. Okay. Let's just have a look at the questions. So there's some questions in the chat. Why is it that we need to set off our accumulated depreciation before processing the revaluation journal? So we need to set off that because we are using the net replacement value method. Okay. We need to, it's almost like we are working out the carrying amount. We are, instead of having plant cost and the accumulated depreciation, we are setting off our accumulated depreciation against the plant cost, almost to reduce the value of the asset to its carrying amount. Because that is what we do when we do the revaluation model. We compare the carrying amount to the fair value. So by setting off the accumulated depreciation to the plant cost, we are like getting the effect of the carrying amount. And we do the set off because we are using the net replacement value method. And under the net replacement value method, it says we must set off the accumulated depreciation against the plant cost just before the revaluation. So someone is saying, so we don't include impairment in the PPE note when using the revaluation method. Okay, so remember I said at the beginning of the lecture that revaluations together with impairments is scoped out. Okay, so we don't look at impairments when we have the revaluation model for purposes of this module. Okay, so if we had, remember in the PPE note, each company is going to prepare one property, plant, and equipment note. And it's possible that the company has buildings carried under the revaluation method, but then has vehicles carried under the cost method. So remember, under the cost method, we will have impairments. When we prepare the property, plant, and equipment note, we're going to have all of our different classes of assets. So not all classes of assets will be carried at the revaluation model. Some will be carried at the revaluation model, some will be carried at the cost model. So under the cost model, we probably could have impairments that will be disclosed in the note. But under the revaluation model, for purposes of this module, you won't have impairments for that class of assets because impairments and the revaluation model together are scoped out for this module. So you'll have impairments under the cost model for those assets that are carried under the cost model, And for those assets under the revaluation model, you'll have to show those, okay? But you won't have impairments for the assets carried under the revaluation model for purposes of this module because it's scoped out. Okay, so let's continue with the notes to the financial statements. So they're telling us now about the revaluation. So they're saying that the machinery was revalued by Mr. X, a sworn appraiser, to its fair value on 1 Jan 2013. So revaluations are performed every 3 years. That was given in the scenario. The valuation technique used to determine fair value was the income approach, where inputs included the market expectations regarding discontinued future cash flows. So all inputs are level 1 inputs. The fair value adjustment was recorded on a net replacement value basis. If machinery was stated at cost less amounts, the carrying amount would have been 420,000. So remember, even though we are carrying the machine under the revaluation method, remember I said we must still disclose the carrying amount under the cost method, and that is so we can compare to other machines, to other companies that have machines that carry their machines under the cost method. It makes the companies more comparable. Okay, so all of this information was given in the scenario here for the notes to the financial statements. Okay, so that is the end of this lecture on revaluations. Okay, so do you guys have any questions? Yeah, you can just type your questions in the chat box. If you have